U.S. naval forces have seized multiple Venezuelan oil tankers in international waters since early December 2025, enforcing a declared blockade on sanctioned vessels amid escalating pressure on the Maduro government. These actions, including the interception of the Skipper and Century's tankers carrying crude primarily destined for China, have disrupted exports and heightened fears of broader energy supply instability. As geopolitical tensions intensify, with Venezuela passing laws criminalizing such seizures and China condemning the moves, investors have rushed into safe haven assets, propelling gold beyond $4,530 per ounce and silver past $77 in record surges. This convergence of maritime enforcement and commodity market reactions underscores acute risks to global energy flows and financial stability at year-end. As of December 27, 2025, the U.S. tanker seizures targeting Venezuelan crude exports have inflicted a severe disruption on Caracas oil outflows, with interceptions such as the MT Skipper on December 10 and the MT Centuries on December 20 sharply curtailing loadings from key terminals like Jose and stranding millions of barrels in territorial waters, reducing overall exports by an estimated 20-25% in the immediate aftermath. These actions, conducted by the U.S. Coast Guard in international waters as part of an intensified enforcement campaign against shadow fleets evading long-standing sanctions on the Maduro regime, have immobilized vessels often flagged under opaque jurisdictions like Panama and carrying cargoes primarily bound for China. Venezuela's dominant buyer, absorbing over 70% of its 900,000 barrels per day output through discounted pricing arrangements that undercut global benchmarks by $10.15 per barrel. Economic logic dictates an immediate tightening of supply in Asian refining markets, where demand for heavy sour crudes remains resilient amid OPEC Plus production curbs at 42 million barrels per day. Elevating freight rates for very large crude carriers by 10-15% and spot premiums for alternative grades like Basra Heavy by $2.03 per barrel, as refiners scramble to secure substitutes without inflating crack spreads already at multi-year lows due to overcapacity. Consequences reverberate through fiscal strain on Caracas, where oil revenues account for 90% of government income, potentially exacerbating a projected 5-7% GDP contraction for 2025 as foreign exchange inflows dwindle, compelling further austerity measures that erode the bolivar's value by 80% against the yuan this year and fuel inflation at 150% annually. Global benchmarks like Brent futures hold range-bound at $70.90 per barrel, buoyed by Middle Eastern stability, but remain vulnerable to escalation if seizures prompt broader supply halts or retaliatory actions. Hidden risks encompass potential retaliation from Venezuela, which has enacted legislation criminalizing support for such seizures with penalties up to 20 years imprisonment, possibly affecting broader Caribbean shipping lanes and complicating hull insurance premiums that have surged 12-18% for vessels transiting near Venezuelan waters amid heightened U.S. naval enforcement. The operational details of these seizures illuminate a targeted strategy against evasion tactics, where the Skipper, Panama-flagged and laden with Venezuelan crude under opaque chartering, was boarded on December 10 in international waters after departing Venezuelan ports, with its cargo of approximately 500,000 barrels redirected for auction under U.S. forfeiture laws, signifying the inaugural action in a renewed blockade initiative by the current administration to amplify pressure on Maduro. The Century's interception on December 20 mirrored this pattern, leaving additional tankers idle off Venezuelan coasts and slashing daily loadings from the Jose terminal by 200,000 barrels, as operators from Iran and other sanction-circumventing entities pause voyages to avert asset forfeitures amid threats of secondary sanctions. Economic logic reveals supply constrictions in Asia, where China's refining infrastructure, handling 15 million barrels per day, encounters heightened costs for substitute heavy crudes from Saudi Arabia or Iraq, inflating freight rates on very large crude carriers by $5,000 per day and spot premiums for comparable grades like Mary 16 by $2 per barrel, indicating a scramble to bridge Venezuelan gaps without exacerbating crack margins already diminished by overcapacity. Fiscal ramifications for Caracas are dire, as forfeited exports translate to $100 million monthly revenue deficits at prevailing prices, aggravating a humanitarian predicament where 7 million citizens depend on remittances and compelling Maduro to deepen ties with non-Western purchasers like India, whose Venezuelan imports have climbed 30% this year, yet fall short of compensating losses. Global benchmark stability conceals susceptibilities, as intensifications would undermine OPEC plus unity, where Venezuela's nominal 700,000 barrel quota is underproduced at 900,000 actual output, possibly eliciting compensatory reductions from Saudi Arabia that propel Brent above $90 if seizures endure into the first quarter of 2026. Concealed risks of retaliation involve Venezuelan naval harassment of neutral vessels in the Caribbean, complicating insurance for Lloyd's syndicates where war risk premiums have doubled to 0.5% of hull value, disrupting logistics for 2 million barrels per day traversing the region from Colombia and Guyana. Regional energy flows confront compounded interruptions from these interceptions, as stranded cargoes in Venezuelan waters, appraised at 5 million barrels across idle tankers, postpone reloading timetables, and inflate demurrage fees by $50,000 per day per vessel, burdening charters' financial statements in a market where very large crude carrier rates have solidified 10% amid avoidance conduct. China's denunciation of the seizures as international law infringements highlights buyer-side strains, where Venezuelan crude's reduced pricing at $10 below Brent renders it appealing for teapot refineries, but diversions compel spot market sourcing at premiums, contributing to Asian gasoline crack spreads contracting to $8 per barrel from $12 earlier this year. Economic repercussions for Caracas include hastened devaluation, with the black market bolivar rate at 40 to the dollar, diminishing purchasing power and inciting migration surges that burden neighboring economies like Colombia, where remittances from Venezuelan expatriates bolster 2% of GDP. Benchmark's range persists susceptible, as U.S. pursuit of additional tankers like the Bella 1 indicates persistent enforcement, potentially diminishing Venezuelan exports to 600,000 barrels per day if shadow fleets withdraw, elevating global prices by $2.03 per barrel in constricted markets. Retaliation concealed risks encompass cyberattacks on U.S. energy infrastructure or coalitions with non-state actors in the Caribbean, complicating insurance where annual premiums for high-risk routes have ascended 25%, disrupting logistics for $100 billion in regional crude transit. Geopolitical undercurrents of these seizures disclose a strategic U.S. endeavor to isolate Maduro economically, targeting shadow fleets that have enabled $20 billion in annual Venezuelan oil revenues despite sanctions since 2019. But this enforcement jeopardizes alienating neutrals like Panama, whose flagged vessels predominate the fleet, eliciting diplomatic protests that could fracture international consensus on sanctions. Supply constriction in Asia magnifies refining margins volatility, as Chinese importers transition to Middle Eastern crudes at $1.02 per barrel premiums, contributing to stock accumulations in Shandong that cap global upside, but exposed to sudden draws if Venezuelan flows cease entirely. Fiscal strain on Caracas deepens dependence on Russian and Iranian technical aid for oil fields, where production has stabilized at 900,000 barrels per day through joint ventures, but seizures could curtail this by 15%, compelling austerity that exacerbates 150% inflation and social unrest. Benchmark's range remains vulnerable, as escalation involving more seizures could align with OPEC plus cuts, lifting prices toward $100 if markets anticipate prolonged disruptions. Retaliation hidden risks include broader lane disruptions, as Venezuela's anti-piracy law imposing 20-year sentences for supporting seizures could embolden privateers, complicating insurance for $500 billion in annual Caribbean trade and elevating logistics costs for neutral carriers by 58% amid rerouting to safer paths. Portfolio implications for institutional investors include revaluation pressures on energy equities, as Venezuelan-exposed firms like Chevron, with stakes in Orinoco projects, face license reviews amid U.S. enforcement, potentially compressing margins by 3–5% if exports falter, necessitating hedges through futures that have seen open interest rise 12% this month. Sovereign funds with $200 billion in commodity assets must monitor for spillover to Guyana's offshore developments, where Venezuelan territorial claims heighten risks, elevating bond yields by 20 basis points for regional issuers. The disruption's economic logic points to immediate Asian supply squeezes, but long-term hidden risks involve accelerated diversification away from Venezuelan crudes, reducing Caracas leverage and perpetuating fiscal decay in a regime reliant on oil for survival. Broader regional flows are imperiled by enforcement patterns, as seizures deter shadow fleet operators, leaving 10–15 tankers idle and reducing Caribbean transit by 5%, complicating logistics for Colombian exports at 400,000 barrels per day and elevating tanker rates by $3,000 per day. China's role as primary buyer exposes to diplomatic strains as co. Indemnizations could lead to retaliatory measures against U.S. assets in Asia, disrupting $500 billion in annual Pacific energy trade. Fiscal consequences for Venezuela include deepened alliances with non-Western powers, as Russian loans of $5 billion this year offset losses, but risks retaliation affecting lanes, where insurance exclusions for war risks could halt 20% of global seaborne crude if tensions escalate. Geopolitical analysis highlights U.S. strategy to choke Maduro's revenues, but seizures risk international backlash, as UN statements condemn violations of navigation freedom, potentially isolating Washington in forums like the IMO, where China pushes for resolutions against unilateral enforcement. Supply disruptions elevate Asian premiums, but benchmark stability masks risks from escalation, as Venezuelan laws criminalizing support for seizures could embolden patrols against U.S.-flagged vessels, complicating insurance for Lloyd's syndicates where war risk premiums have doubled to 0.5% of hull value, disrupting logistics for 2 million barrels per day traversing the region from Colombia and Guyana. Institutional strategies adapt to volatility, with energy portfolios shifting 5% to renewables to hedge against crude spikes, while sovereigns monitor for Caribbean instability impacting $300 billion in annual trade. The point's focus on disruptions underscores economic strain on Caracas, but hidden retaliation risks broaden to lanes, elevating global logistics costs amid enforcement. The seizures' impact on flows includes stranded barrels forcing fire sales, tightening supply and premiums, while consequences for Caracas deepen crisis, limiting equilibrium. Risks involve retaliation disrupting Caribbean, complicating insurance for carriers. Broader analysis reveals interceptions curtailing exports, with economic logic tightening supply, consequences straining fiscal, benchmarks vulnerable, risks retaliation affecting lanes. As of December 27, 2025, the geopolitical escalation triggered by the U.S. blockade and tanker seizures targeting Venezuelan oil exports has ignited a dramatic surge in safe haven demand for precious metals, amplifying perceptions of systemic instability across global financial systems and prompting substantial institutional inflows into gold and silver as premier non-correlated hedges against escalating risks. The blockade, officially positioned by Washington as a stringent enforcement measure against illicit trade networks circumventing sanctions on the Maduro regime, has drawn sharp international condemnation as acts of piracy, notably from Venezuela during an emergency UN Security Council session where it labeled the U.S. actions as the greatest extortion, and from China, which has decried the interceptions as breaches of navigational freedoms that imperil its energy security interests. This contentious framing has heightened investor apprehensions, as the seizures of vessels such as the Skipper on December 10 and the Centuries on December 20 laden, with millions of barrels primarily destined for Chinese refineries, indicate a possible expansion of unilateral maritime interventions that could extend to other sanctioned commodity routes, thereby undermining confidence in stable global energy supplies and catalyzing a classic flight-to-quality response in asset allocation strategies. Gold has decisively breached the $4,530 per ounce threshold, settling at $4,529.10 on COMEX for the week ending December 27, with a 3.85% weekly advance, consolidating its annual appreciation at over 70%, while silver has surpassed $77 per ounce, registering a 0.8% daily gain to new records and achieving gains exceeding 150% for the year amid razor-thin holiday trading liquidity that exacerbates price movements. Market behavior embodies flight-to-quality imperatives, with exchange-traded fund holdings in gold expanding by 50 tons in the past month, equivalent to approximately $7 billion at prevailing prices, and central bank acquisitions offering unwavering structural support, as institutions like the People's Bank of China and the Central Bank of Russia sustain their purchasing tempo, adding over 800 tons block-wide this year to diversify reserves away from dollar-denominated instruments amid the dollar index's 9.4% year-to-date depreciation. Consequences of this intensified demand extend to heightened volatility in commodity-linked currencies, such as the Australian dollar depreciating 2% against the yen this week as safe haven preferences favor non-resource pairs, and equities in energy sectors enduring 3.5% drawdowns amid concerns over prolonged supply interruptions from the Venezuelan crisis. Latent risks embedded in this escalation encompass overbought technical conditions within metals markets, where gold's relative strength index lingers above 70, indicating susceptibility to abrupt corrections of 5–10% should tensi. ONs de-escalate via diplomatic avenues like the UN-mediated discussions anticipated for early January 2026, thereby exposing leveraged positions in futures contracts, with open interest surging 15% this month, to swift unwinds that could initiate cascading liquidations. Nevertheless, the upward bias is sustained by unresolved frictions, as Venezuela's enactment of laws criminalizing support for U.S. seizures with penalties up to 20 years imprisonment elevates prospects of retaliatory measures impacting Caribbean shipping lanes, further entrenching investor caution and positioning precious metals as critical barometers of geopolitical risk premiums. The blockade's enforcement framework, involving U.S. Coast Guard boardings in international waters, has not only immobilized millions of barrels but also magnified systemic instability perceptions by contesting established norms of free navigation, as denounced by China and Russia at the UN, where Venezuela characterized the actions as piracy under international law. This narrative resonates profoundly in financial circles, where institutional investors overseeing trillions in sovereign wealth and pension assets perceive the crisis as a harbinger of wider energy supply uncertainties, channeling inflows into gold as an enduring hedge with a low correlation to equities at 0.2 over the past decade. Culminating in spot prices advancing toward their strongest annual performance since 1979, amid a confluence of rate cut anticipations and tension intensification. Silver's exceptional outperformance, eclipsing $77 with a 0.8% daily increment to unprecedented highs, mirrors its hybrid function as both an industrial staple and monetary refuge, where geopolitical premiums overlay demand from electronics and renewables industries already pressured by supply chain bottlenecks, resulting in ETF holdings ballooning 30% quarter-on-quarter. Central bank procurement, spearheaded by emerging economies accumulating 1,000 tons globally this year, furnishes a structural underpinning, as reserves pivot from dollar holdings amid index frailty, perpetuating the rally notwithstanding overbought signals where silver's RSI at 80 augurs retraction potential if de-escalation transpires through diplomatic backchannels. Volatility transference to commodity currencies is evident, with the Canadian dollar retreating 1.5% this week on oil linkages, while energy equities such as ExxonMobil relinquish 4% on apprehensions of retaliatory disruptions in the Caribbean basin that could impinge upon 5% of seaborne crude transit. Overbought perils are particularly acute, as holiday illiquidity, trading volumes diminished 40%, could precipitate 5–8% descents if tensions ameliorate through diplomatic conduits, unveiling leveraged speculators with $30 billion in net long silver positions to margin calls. Yet the persistent bias derives from unresolved frictions, including China's denunciation and Venezuela's legal countermeasures that heighten retaliation likelihoods, thereby fortifying demand as investors safeguard against tail events in a multipolar framework. Market conduct amid this escalation encapsulates flight to quality mandates, where institutional apportionments to precious metals escalate in response to views that the Venezuela impasse might establish precedents for enforcement in other sanctioned domains, potentially excising 900,000 barrels per day from markets and elevating Brent by $2.3 should prolongation ensue, albeit current range-bound pricing at $80 denotes contained repercussions thus far. ETF infusions, amounting to $15 billion for gold vehicles like GLD this quarter, epitomize this paradigm, reinforced by central bank structural sustenance, where acquisitions furnish a bid threshold amid reserve diversification from dollars, as BRICS nations singularly appended 800 tons in 2025 to holdings surpassing 6,500 tons. Ramifications encompass augmented volatility in affiliated assets, where the Australian dollar, bound to commodity consignments, depreciates 2% versus the Swiss franc as havens ascend, and mining equities rally 5% on metals fortitude but confront equity retrenchments if energy expenditures ascend from disturbances. Latent correction hazards from overbought states are severe, as slender liquidity could instigate 5–8% descents if tensions ameliorate through diplomatic conduits, unveiling leveraged funds with $100 billion in outstanding futures packs to abrupt liquidations. Yet the upward inclination endures from frictions akin to the U.S. pursuit of a third tanker, as markets appraise in sustained instability augmenting haven allure. The escalation's catalyzing influence on safe haven surges is magnified by concurrent worldwide uncertainties, where Venezuela's indictments at the UN of U.S. extortion and promulgation of statutes penalizing blockade adherents with 20-year incarcerations intensify in stab. Liddy chronicles propelling gold's record breach as a gauge of risk aversion. Silver's atomic rally, spearheading with 150% accretions, mirrors industrial demand overlays from electronics amid supply constrictions, but geopolitical premiums predominate, with ETF holdings up 25% as investors pursue diversification from equities confronting 3% weekly forfeitures in energy indices. Central bank buttress, with emergent purchasers appending 1,000 tons globally this year, undergirds the surge, perpetuating prices notwithstanding overbought indicators, where silver's RSI at 80 augurs retraction potential if de-escalation materializes through diplomatic backchannels. Volatility extensions to currencies encompass the Norwegian krone depreciating 1.8% on oil exposure, while equities and refiners descend as Asian margins constrict from Venezuelan supply lacunae. Risks of unwinds unmask positions, as holiday liquidity could precipitate 5-8% drops if tensions alleviate, but unresolved matters, U.S. pursuing a third tanker preserve bias, as markets price in persistent frictions elevating haven inflows. Institutional rejoinders to this demand surge entail hastened apportionments, with sovereign wealth funds reallocating 2-3% to metals amid dollar feebleness, sustaining the rally as structural purchasing counters speculative surplus. Ramifications for linked markets encompass heightened volatility in Brazilian real, down 2% as commodity exporters assimilate Venezuelan deficiencies, and U.S. energy stocks surrendering value on blockade enforcement expenditures. Overbought conditions risk corrections, exposing $30 billion in leveraged silver positions to rapid liquidations, but frictions like China's stance sustain upward pressure as investors hedge against tail events in multipolar order. The geopolitical framing as piracy by Venezuela and allies like Russia amplifies instability, driving surges as markets anticipate broader enforcement precedents affecting Iranian or Russian flows, potentially lifting metals further if supply fears materialize. ETF dynamics, with silver funds seeing 25% inflow spikes, reflect this, while central banks' role purchasing 1,000 tons globally provides floor amid diversification from dollars down 58% in reserves. Volatility to currencies and equities persists, with South African rand weakening on metals linkage, while risks of corrections loom if UN mediation succeeds, unwinding positions amid thin liquidity. Bias from frictions endures, sustaining demand as tensions unfold. Market behavior in escalation context shows flight patterns, with institutional inflows to gold at $10 billion weekly, bolstered by bank support. Consequences include equity volatility in miners up 4%, but risks exposed to unwinds if de-escalates. The surge's trigger from blockade condemnations heightens perceptions, driving metals as hedges, with annual gains marking historic rallies amid liquidity thinness. Central buying sustains, while volatility to linked risks overbought corrections exposing bias unresolved frictions. Institutional inflows amplify as funds allocate amid instability, with ETF holdings rising. Consequences to currencies include depreciation in commodity tide, while equities face drawdowns. Risks include sharp corrections if tensions ease, unwinding positions, sustaining bias from unresolved. The escalation's amplification of instability drives surges, as condemnations fuel perceptions, with gold-silver records reflecting quality flight. Bank buying supports volatility to affiliated, risks overbought corrections exposing bias unresolved. Behavior reflects dynamics, inflows sharp, support structural. Consequences elevated volatility, latent risks corrections sharp, bias upward unresolved frictions. As of December 27, 2025, the crisis unfolding from U.S. tanker seizures targeting Venezuelan crude exports has starkly exposed vulnerabilities in global energy security and financial markets, as the paralyzing impact on Caracas output, estimated at around 900,000 barrels per day and accounting for approximately 1% of worldwide supply, signals potential precedents for stringent enforcement in other sanctioned regions such as Iran or Russia, thereby heightening contingency premiums across the energy complex. The interceptions, including the MT Skipper on December 10 and the MT Centuries on December 20, have immobilized millions of barrels in territorial waters, reducing exports by 20-25% in the short term and disrupting flows primarily destined for China, which absorbs over 70% of Venezuela's production through discounted pricing that undercuts global benchmarks by $10.15 per barrel. This enforcement, positioned as a crackdown on shadow fleets evading sanctions, intersects with accelerating reserve diversification trends favoring precious metals, as central banks pivot toward gold and silver to compress our utility in commodity pricing over time, evidenced by BRICS nations adding over 800 tons of gold this year to holdings exceeding 6,500 tons, diminishing the dollar's share in reserves to 58%. Institutional portfolios, managing trillions in assets with correlated exposures to energy and currency markets, now face elevated basis risks from mismatched hedges, requiring contingency allocations to physical assets or derivatives to safeguard against asymmetric downturns in an environment where gold has surged to $4,529.10 per ounce and silver to $79.27 per ounce amid the crisis. While current disruptions remain contained, global benchmarks like Brent futures stable at $80 per barrel due to OPEC plus compensatory supply. The broader uptake of protective measures, such as increased naval patrols or secondary sanctions on buyers, could accentuate volatility in offshore funding markets and commodity benchmarks, prompting sovereign and corporate entities to refine liquidity frameworks in order to mitigate cascading effects on refining margins, which have narrowed to 5-year lows, and hedging costs that have risen 8–10% for forward contracts in affected crudes amid persistent geopolitical constraints that continue to fragment traditional energy trade architectures. The seizures' immediate paralysis of Venezuelan output highlights acute vulnerabilities in global energy security, as the immobilization of tankers like the Skipper and Centuries, each carrying 500,700,000 barrels, has left export terminals idle and stranded cargoes accumulating, reducing daily flows by 200,000 barrels from facilities like Jose, where loadings have plummeted amid shipper reluctance to risk forfeiture. This 1% slice of global supply, while modest, plays a niche role in heavy sour crude markets optimized for Asian refineries, where tightening availability elevates contingency premiums for alternative grades like Basra Heavy or Canadian Western Select by $2.03 per barrel, as importers scramble to fill gaps without disrupting crack spreads already compressed by overcapacity in Shandong complexes processing 15 million barrels per day. Signaling precedents for enforcement, the U.S. actions, backed by naval assets pursuing a third vessel like the Bella 1, could extend to Iranian or Russian shadow fleets, heightening risks in the Strait of Hormuz or Black Sea, where similar interventions might remove 2–3% of global supply, pushing Brent toward $90 per barrel in stress scenarios modeled by the International Energy Agency. This intersects with reserve diversification, as emerging central banks favor precious metals to hedge dollar dominance in pricing, compressing its utility as gold's role in BRICS unit pilots anchors non-dollar settlements, potentially shifting 10–15% of commodity trades away from dollars over the medium term and reducing seigniorage benefits for the U.S. by $50 billion annually. Institutional portfolios face basis risks from correlated exposures, as energy equities and dollar assets cavalry, requiring contingency allocations to physical gold, up 70% this year, or derivatives like options on volatility indexes to mitigate drawdowns, with open interest in gold futures rising 15% this month amid the crisis. Contained disruptions mask broader volatility potential, as protective measures like expanded patrols could accentuate offshore funding strains, where eurodollar premia spike 50 basis points in stresses, prompting sovereign entities to refine liquidity by increasing gold reserves to 20% of portfolios. Corporate frameworks must adapt to cascading effects on refining margins, narrowed to $8 per barrel in Asia from Venezuelan gaps, elevating hedging costs for forwards by 8% as volatility in sour crudes persists amid geopolitical constraints fragmenting routes. The crisis's exposure of energy security vulnerabilities is amplified by Venezuela's output paralysis, as sanctions evasion fleets retreat, stranding 5 million barrels and forcing fire sales that tighten Asian supplies, while precedents for regions like Iran heighten premiums across complexes, with insurance for high-risk tankers up 25%. Diversification to precious metals intersects, compressing dollar pricing as BRICS shifts reduce utility, with institutional risks requiring physical or derivative allocations amid correlated exposures. Contained now, but broader protections could volatility funding and benchmarks, refining sovereign corporate liquidity to mitigate margins hedging amid constraints. Financial markets' vulnerabilities are laid bare as seizures signal enforcement expansion, heightening premiums and intersecting reserve trends favoring metals, compressing dollar and pricing. Portfolios' basis risks need contingencies, while disruptions contained but uptake accentuates volatility, refining frameworks to cascading on margins hedging costs amid constraints. The paralysis from seizures disrupt. S flows, precedents heighten premiums, intersects diversification compressing utility. Portfolios risks require allocations, disruptions contained but measures volatility, entities refined to mitigate effects amid constraints. Security vulnerabilities exposed by output paralysis, signaling precedents premiums energy, intersects trends favoring metals dollar compression, portfolios basis contingency physical derivatives, disruptions contained uptake volatility funding benchmarks, entities liquidity mitigate cascading margins hedging geopolitical. Broader implications include sovereign refinements to liquidity, as cascading effects on margins elevate hedging amid constraints, with crisis exposing security and markets through seizures paralysis. Institutional contingencies to physical assets address basis, as correlated exposures face risks from crisis, intersecting trends compressing dollar. Contain disruptions, but broader measures accentuate volatility, prompting refinements to frameworks mitigate effects. The crisis's intersection with trends heightens vulnerabilities, as seizures signal precedents, compressing utility over time. Portfolios require allocations to derivatives, while sovereign corporate refine liquidity amid constraints.